Hi and welcome to Swissquote's daily market talk. It's Monday, April 7th, and it's a bloodbath wherever we look in the market this morning. Capital flows to safe haven assets and bonds on rising bets that the central banks around the world will have no choice but to step in sooner rather than later to fix the situation. I think that's all you need to know for now. So yes, Friday marked the end of a hectic week of trading due to tariffs, while last week marked the beginning of a terrible market sell-off across the global financial markets, to say the least. The sell-off on Friday actually accelerated after China stepped in and said that they would respond to the US tariffs with 34% tariffs on American imports on their own. Europeans also warned that when elephants fight, grass trembles. I'll say that retaliation smells stronger today than negotiation with the Europeans. The European leaders will be meeting today, and let's see what comes out of that meeting. Meanwhile, we saw a much better than expected NFP report on Friday. The non-farm payrolls in the US jumped nearly 230,000 last month. Even government jobs increased by 19,000. Then wages growth came in slightly lower than expected by analysts, but unemployment rate rose slightly. But all in all, and in all cases, the latter saw little market reaction as Fed President Jerome Powell said that the impact of tariffs on the US economy could be higher than expected, adding that there is no rush to cut the interest rates in the US. Voila. That was, I think, the last nail in the coffin, because the S&P 500 lost 6% on Friday. Yes, 6% on Friday, bringing two-day losses to about 10%. The index is down by more than 17% right now since the February peak and has slipped below the major 38.2% Fibonacci retracement on the AI rally that had started at the beginning of 2023, remember? In other words, while the S&P 500 has now stepped into the bearish consolidation zone. And we have obviously a similar picture for the Nasdaq 100 index. The index lost more than 6% on Friday's trading session. Here, the accumulated losses since the February peak in Nasdaq 100 is already above 20%, and the technology-heavy index also closed below its own major 38.2% Fibonacci retracement level on the AI rally on Friday as well. So it's also in the bearish consolidation zone right now. The Dow Jones is also in the bearish consolidation zone, mind you, while the small and medium cap stocks in the US that were supposed to be the best Donald Trump trades, remember, are the most hit among others. They lost between 60 and 80% of their post-election gains already. Elsewhere in the world, the CSI 300 index is down by more than 6% this morning, in that despite the China's pledge to step in and ease the financial conditions in China significantly to bring support to the economy. The Hang Seng is down by more than 10%. Nikkei is giving signs of some dip buying at the time I'm talking here after an early slump, but hey, I mean, wherever we look this morning, it is a bloodbath, and the sell-off that we see today in the global financial markets happened only 3 times in the past. For the S&P 500, it was 1987's Black Monday, the global financial crisis, and COVID. So it's bad. I mean, it's really bad by historical terms. The market volatility is spiking, obviously, and the futures this morning are looking so bad, guys, that I'm just like wondering whether we should just pack and leave for the week. I mean, the S&P 500 futures are down by almost 4% at the time I'm talking here right now, and the Nasdaq futures are also down by more than 4% right now. Same for the European futures, and the week hasn't even started yet. We are before the European opening bell. And even gold is no longer willing to play. The price of an ounce tanked around 2.5% on Friday's trading session from record highs and was lower this morning. Although note that the ugly market sell-off that we see today should keep gold appetite quite strong despite all. So if you're wondering, where does the capital flow right now? Well, it flows into the government bonds because the US, the German, the Japanese, the Australian yields, they are all lower right now, and that is because we start seeing growing expectations that the financial turmoil of the moment will soon bring the central banks around the world back to cutting their interest rates and purchasing bonds to ensure financial stability. I mean, look, the US 2-year yield is down to 3.5% despite Jerome Powell's message last Friday that there is no rush to cut the interest rates in the US. I mean, investors clearly respond. If the sell-off continues, the Fed will have no choice but to do something. So bonds are probably a good place to hide right now, in my opinion. In the FX markets, the US dollar was better bid in the last hours of trading last Friday, but the greenback is plunging again this morning against major peers. So in this context, the euro dollar actually just couldn't close last week's trading session above that 110 psychological level, but the pair is strongly bid this morning against the US dollar and is about to cross that 110 level very shortly. Cable on the other hand slipped below the 130 psychological level last Friday as well, but is also better bid this morning against a broadly smashed US dollar. And the Japanese yen and the Swiss franc are amassing heavy safe haven flows this morning and well since last week, increasing the chances, by the way, of further rate cuts in Switzerland, as Switzerland hates to see the franc explode to the upside when their exporters have been imposed 30% tariffs by the US last week. So it's all very much hectic. So overall, in summary, the equities are down, bonds are up, gold eases as well, and crude oil, oh my god, crude oil is doing so badly as well. I mean, the barrel of US crude lost more than 6% on Friday's trading session and tipped a toe below the $60 per barrel psychological level this morning as Saudi Arabia decided to cut its oil price to Asia to a 4-month low on rising recession odds due to tariffs. And the outlook here remains comfortably negative for oil, mind you, with the possibility of a further fall toward the $50 per barrel level. Price recoveries could eventually be interesting stop-selling opportunities for investors that are willing to play the negative outlook story due to the rising recession odds. Now, this week, the US will release its latest CPI update and is expected to have mostly ease on yearly and monthly basis, except for monthly basis for core inflation that's expected to have slightly accelerated. But it does not matter really. I mean, the Federal Reserve's got to do what it's got to do to fix the situation before fixing inflation and inflation expectations probably. So this week's inflation report from the US will probably go unheard. We will be talking about tariffs more probably. But more interestingly, the US earnings season kicks off this week in the middle of this jungle of uncertainty, with the big US banks due to announce their first quarter earnings later this week. TSMC will also report its March sales on Thursday, and note that attention will be on companies' forecasts, not necessarily results, but forecasts regarding the tariff disaster and how bad they see the future with heavily disrupted supply chains. Now, 64% of the S&P 500 companies have already downgraded their earnings projections, obviously. So that's a good thing, mind you. It means that a part of the damage is already priced in the market prices. But with nearly 70% of the US GDP coming from consumer spending, it will be quite hard for companies to sound okay facing massive tariffs. So all in all, the S&P 500 companies are expected to have increased their profit by about 7% last quarter. It would actually be the 7th straight quarter of gains for the US S&P 500 equities on annual basis, according to FactSet, but it's down from more than 11% penciled in earlier this year. So the expectations are also crumbling right now. Now, all this being said, I believe that we will be seeing incredible buying opportunities in just a few weeks from now. So keep calm and don't forget that the markets have recovered. They have always recovered, even from the worst crisis. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good luck trading.